Good morning. Welcome to the Atlantic Council. I'm Josh Lipsky, Chair of International Economics at the Council and Senior Director of our Geoeconomics Center. And we are pleased to welcome you to the Global Economic Outlook in 2026, our annual tradition, first event of the year. And I'm welcoming back for the fifth time, this deserves some kind of medal, Jan Hatzius, Chief Economist at Goldman Sachs, Head of Global Investment Research. Jan, very grateful once again for your time joining us here at the beginning of 2026.
Hello, Josh. It's wonderful to be with you and with all of our listeners and participants today. And this has become a very cherished tradition and look forward to the discussion.
Well, let's jump right in. We have 45 minutes. We have hundreds of online viewers who I know want to ask questions, and they can do that through askac.org. Jan, we're going to spend the majority of this time looking ahead, but we have to spend 1 or 2 minutes looking back on the tumultuous, eventful trade resets and all else that happened in the global economy in 2025. And I wanted to start there. If we look at what happened in 2025 when we had this conversation a year ago, Goldman projected, you projected 2.5% US growth. It came in a little lower at 2.1. On global growth, you were spot on at 2.8% global GDP growth. What surprised you and what didn't in 2025?
Yeah, what surprised us was that the increase in tariffs was bigger than what we had in our baseline assumption, closer to our risk case, but definitely a more pervasive increase in tariffs. And that, I think, explains why US growth was weaker. The shock was bigger. But if I step back from the specific numbers, I think the title of our outlook going into 2025, which was Tailwinds, Probably Trump Tariffs, held up reasonably well. Didn't always look like it, and it certainly didn't look like it for a while in March and April. But in the end, I think that's what happened. And some of that was the fact that the tariffs didn't increase by as much as seemed likely for a while around Liberation Day. But I think it's also true that the global economy was maybe a bit more resilient to tariff increases than many had thought, partly because of the tailwinds that we were getting, in part from aspects of the new economic policies around fiscal and regulation, and partly because of continued post-pandemic healing that I think benefited the US, but also other economies that were still recovering from the pandemic.
So tariffs is a story that's not going to go away, and we'll talk about their impact in 26. We're obviously all awaiting a potential Supreme Court decision, could be as soon as tomorrow. But let's just talk broadly about your projection for the US economy. We'll start there and then we'll go global for 26. And I want to pull up what we have as designated chart 2. This is from your excellent outlook, the Goldman Excellent Outlook. And this is the projection, if we can put it up, that shows where Goldman is on US GDP growth versus the consensus on Wall Street, and where we have inflation projections for Goldman. And I think you, Jan, and Goldman are at 2.6% US GDP growth. I think the market's a little below that. So take us through your more bullish forecast.
Yeah, on the growth side, we're at two and a half or a little bit more, depending on whether you look at it fourth quarter to fourth quarter or annual average, but definitely above the consensus. And the drivers of growth for me are basically threefold. One, the tariff impulse goes from significantly negative in 2025 to neutral and maybe ultimately even slightly positive in 2026 if we do see a small erosion of the average effective tariff rate, as perhaps it becomes harder to fully replace the tariffs through the IEEPA legislation, the International Economic Emergency Powers Act that is at issue at the Supreme Court. And perhaps there is some incentive to shave tariffs here and there in the run up to the midterm elections. So the tariff impulse, the negative tariff impulse on growth, I think is very much in the rearview mirror. Second driver of growth in 2026 is the fiscal boost, the tax cuts in the One Big Beautiful Bill Act, which are taking effect mainly in the first half of 2026. And there's an aspect here of full expensing of plant and equipment, which is going to have a positive impact on the corporate sector and probably on business investment. Tax refunds for households are going to be quite a bit higher than normal. That should support consumer spending. And we're estimating that fiscal policy adds a half to 3/4 of a percentage point to growth in the first half of this year. And then lastly, financial conditions have been easing as we've gone through most of 2025, at least post-Liberation Day. And that's been for a variety of reasons, but in part because the Fed's been cutting interest rates. And that impulse to growth is also probably going to be most visible in early 2026. So all of that gives us an above consensus growth estimate. You'll note that one item that may be missing from this list is AI investment. We don't actually view AI investment as strongly growth positive. I think there's a lot of misreporting actually of the impact that AI investment had on US GDP growth in 2025. And it's much smaller than is often perceived because most AI equipment is imported. And that means there's a positive entry in the investment line, but that's offset by a negative entry in the net exports line. And a lot of the AI investment that we're seeing in the US adds to Taiwanese GDP and it adds to Korean GDP, but not really that much to US GDP.
Can I just pause there for a moment? Because your point, and I think this is in the forecast as well, is that basically AI investment has been negligible to US GDP growth in 2025. Is that a fair assessment?
Yes, basically zero. Basically zero.
That seems completely counter to the narrative we read almost every day in financial media, what we hear talked about of AI capex and boosting and how it's basically supporting the US economy through tariff headwinds and otherwise. Where is the disconnect between the reporting and what you're saying here?
Well, again, I think some people forget that you need to look not just at investment, but also at net exports, just from a GDP accounting perspective. There's another more technical point, which is that some of the AI investment, as the AI investment directly in semiconductors, isn't actually classified as investment in the national income and product accounts. It's classified as intermediate inputs. So the national income and product accounts miss that part of investment spending. So we've talked about the true GDP impact, which is still very small, but positive contributor to growth in 2025. And then the measured GDP impact, which is literally, we estimate, zero.
Okay, I think that's just an incredibly important point to underscore and take forward. And then in 26, you estimate slight increase there as investment comes more online?
We do, but it's still pretty small. I mean, the significance of AI and the AI trade, and none of what I'm saying means that I don't think AI is important.
Right.
I think it's very important. And it's obviously very important for financial markets, but the specific impulse from AI investment on GDP is still going to be pretty small, although I do think it's going to be positive to a limited degree this year.
Okay, let me come back to the inflation part of the forecast because you're projecting lower inflation than the street here. I think you're around 2%, so right around the Fed's target. Street's a little higher. Take us into the difference there and then what it means for the Fed throughout the year.
Yeah, the first thing to say is that I view this as our most out of consensus view, not not just inflation, but really the contrast between a solid GDP growth forecast and a low inflation forecast. So how do these things hang together? First thing to say is that the strength in GDP growth, I don't think, is going to result in a tightening in the labor market, or at least a meaningful tightening in the labor market. And we'll get to that. But the basic reason is that we've seen a pickup in productivity growth. And ultimately, the impulse to inflation from the real economy depends much more on the labor market and the tightness in the labor market than on the growth in GDP. So labor market loosened clearly in 2025, and we think is going to stay at this looser level that should support continued deceleration in wage growth and probably continued slowing in rent inflation. So that's going to be helpful. And then in addition, the tariff impact on inflation, which was clearly positive in 2025, we think to the tune of about 50 basis points, contributed about 50 basis points to core PCE inflation. That is going to be rolling off effectively as we go through 2026. We'll anniversary the biggest tariff increases in the spring and summer of this year, and that's going to mean downward pressure from that component. So right now we're running at about 2.7% for core PCE inflation. We're estimating that for the November numbers. And there are some measurement issues around there, but nevertheless, the number is probably going to be 2.7%. And we think that goes to 2.1 or so by the end of 2026. And I feel pretty good about that forecast, even though it might seem like it's at odds with a relatively positive growth outlook.
And for the Fed, then implications in terms of rate cutting for the year with basically an on-target inflation number?
Yeah, there's a pretty wide range of outcomes here. I mean, I think the most likely is that they'll deliver moderately more cuts. We have two more cuts, 50 basis points. We're currently penciling that in for March and June. So we don't have a cut at the January meeting, but then expect them to deliver quarterly cuts. I think it's a bit more of a placeholder forecast than it often is. I certainly want to see tomorrow's employment numbers. I think that's going to be very, very important. We expect the report to look okay, but if it looks weak, then January could come back onto the table. It's a possibility if you have a further increase in the unemployment rate. Under our baseline, though, if the labor market looks a little bit better, it's also possible that these cuts move further into the summer or into the second half of the year. That would also be consistent with the change in Fed leadership. And as we go into the second half of the year, the committee might look somewhat more dovish, and that could mean maybe less cuts in the early part and more cuts later on. So in terms of the total amount of easing, I think 50 basis points is a reasonable baseline. That would take you down to close to 3% for the funds rate, which is their current estimate of neutral. If we're far away from 50 basis points, I think more likely we'd get more cuts, but that's a downside labor market scenario.
Well, that's what I wanted to pick up on the labor market, because for everyone listening, I think it's important to understand the full sort of scope of your forecast here, which is bullish on GDP growth, softer inflation than many expect, but a relatively soft labor market. And the tension between all three of those, is there a time you could point to in recent history in the US where you've seen that kind of dynamic? Because it just seems the interplay between those three is not something we're very used to, at least in recent history.
Yeah, I mean, what's the difference between those those different piece, the growth piece and the inflation piece, it's basically productivity. I mean, if we take growth, we take the unemployment rate, and we take inflation, the thing that ties especially growth and the unemployment rate together is really what happens on productivity. And we are seeing a productivity pickup. I mean, we just got third quarter productivity numbers this morning, and in the period since just before the pandemic, we have seen non-farm business, real GDP per hour worked increase at 2% at an annual rate, up from 1.5% in the prior cycle. That's a meaningful acceleration. And I think arguably we're still in the process of structural acceleration, because I think that 2% still contains very little AI impact. Backward looking, the impact of AI on productivity growth, I think, is pretty negligible. Forward looking, 26, 27, 28, I think we'll see a gradually bigger AI impact. So arguably we're going to see maybe a move up to 2.25% or 2.5% for productivity. That wouldn't be a shocking number. I mean, the long-term average, if you go back more than a century, long-term average for US productivity growth is about 2%. So we've only just caught back up with the long-term average. And there, I think, is every reason to believe that we'll be somewhat above the long-term average over the next 5 years, let's say.
So I have one more US question, and then we're going to turn to the rest of the world, Jan. But we haven't talked a lot about debt and deficits. We haven't talked a lot about the bond market. Do you see any pressures being exerted here? The bond market panicked over Liberation Day. Then, of course, there was the retreat on tariffs. Now the bond market is looking toward those revenues throughout the rest of this year. But do you see any pressures coming on the fiscal side from the US position, or is this just a post-midterms conversation we'll have in 27?
Well, politically it might be, but the underlying pressures, I think, are still building, and we're still in a actually remarkably similar position as where we were a year ago. I mean, we've got tariff revenue running at $350 to $400 billion at an annual rate. If you look at the latest monthly numbers, that's up from about 100 prior to Inauguration Day. So that's a fiscal improvement, if you will. But at the same time, other pieces of the fiscal puzzle have deteriorated. We have seen fiscally expansionary legislation. So our projections for where the US federal deficit is going to be over the next, say, 5 to 10 years haven't really changed. We're still looking at about 6% of GDP federal, about 7 to 8% of GDP for the general government, which is always the number that you need to use if you're engaged in international comparisons. And it really illustrates just the size of the US fiscal imbalance. So that's a number that is going to mean ongoing increases in the debt to GDP ratio, meaning more and more need for investors to hold additional long duration US assets. And that probably is going to mean upward pressure on long-term rates relative to short-term rates. So short-term rates are coming down, but long-term rates are not coming down and might over time, edge higher. And that's what we're building into our forecasts. And you certainly could see, renewed bouts of nervousness about the long-term US fiscal position, which would mean, maybe sharper increases, at least for a period of time, in longer-term US yields. So I don't think that this debate is going away. There's a political cycle around it. And I do think it's more of a post-midterm discussion. Certainly, if you just look at the Washington dynamics, the market dynamics, we're going to have to see. that obviously moves on a different schedule sometimes.
And I know it just happened yesterday, but the president's announcement about defense spending, the possible increase to 1.5 trillion, is that something you've thought about yet in the 12 hours since he's tweeted the announcement?
I mean, I think the general trend for defense spending is, certainly not lower as a share of GDP, and potentially higher. I mean, we're in the 3.5% range for 3.5% of GDP. I don't think that's going down. It may very well go up, just given given what we're seeing in terms of global conflict and divisiveness. And so how these sort of announcements ultimately translate into legislation and appropriations, that's obviously a separate story, but I do think it illustrates the path that we're on.
Okay, let's turn to the rest of the world, and I want to start with China. You are above consensus here on China. I think you're about 4.8% growth. We work with Rhodium Group. They're much lower than that for the Chinese economy. Explain your bullishness.
Well, the starting point is that, 2025, China grew at 5%. And, these are the official GDP numbers. And I know there's always a discussion around the best measure of what's actually going on in the Chinese economy. And I do think there are challenges in interpreting the official GDP numbers. But if I look at the official GDP numbers, I think 2026 is going to look fairly similar to 2025, with the same strengths and weaknesses of the Chinese economy. And the strengths are very much on the external side and the goods producing side, and the continuous upgrading in China's capabilities for making high quality goods at lower and lower prices, and thereby gaining market shares. I mean, it's remarkable how well the goods producing sector held up in 2025, despite the sharp increases in US tariffs on imports from China. And obviously some of that has been taken off, but net, we've still seen a substantial increase in US tariffs on China. That's one of the big surprises. I should have mentioned this actually at the start. If I think back on surprises, I mean, it's a sub point of resilience to increases in tariffs. But this is the really stark one, just how China has managed to continue to export, and overall real export volume growth was close to double digits. So I don't think that's changing anytime soon. China, I think, is going to continue to be an export powerhouse. I think the external accounts and the external imbalance is going to continue to increase. That's positive for China's GDP. It's not necessarily positive for GDP elsewhere, and we'll get to that. Meanwhile, the domestic economy is pretty weak, and the property market is still contracting. Actually, it's still contracting pretty sharply, despite the fact that housing starts and sales are already down 60-70% from the peak. But we're still seeing negative developments there, still negative changes. We're still seeing sharp declines in house prices, and domestic demand's pretty soft. I mean, retail sales are, barely growing. And it's a very unbalanced economy, but when you take it all together, the amount of output, the amount of stuff that China is producing is still growing at a solid pace. And I think that has a lot of problematic implications for the rest of the world. But I do think it's a fact, and I don't think it's going to cease to be a fact.
So this is basically, from your point of view, this is the export-driven Chinese export side of it. It's not about the internal differences in terms of consumer demand, property market. That all remains weak, but the export strategy doubled down from China in the year ahead, and that gives them the growth they're looking for.
That's right. And I think the internal side and the direct and indirect effects of property are still going to be negative. Maybe not quite as negative in terms of the impact on the growth rate as they were in 2024-25, where our team is estimating minus 2 percentage points from the direct and indirect effects of property. For this year, they're estimating minus 1.5 percentage points. But that's still a big negative number.
And that means the current account surplus just continues to grow in China. And we see something unlike we've ever seen in terms of an imbalance, right?
Yes, and especially as an imbalance relative to the size of the global economy. We're in uncharted territory, and we're going to be in uncharted territory increasingly in coming years. We're estimating that we'll get to about 1% of global GDP for China's current account surplus by the end of this decade. Wow. And I should note that some economists, Brad Setzer at the Council on Foreign Relations has written about this a lot, argue that we're already seeing bigger imbalances than what the balance of payments numbers are suggesting because of measurement issues around balance of payments versus customs cleared trade. So if you want to make the argument that we're already at 1% of global GDP or more for this imbalance, you can certainly find data to support that case.
Yeah, Brad and I had a good conversation about that during the IMF annual meetings, and I know he's brought a lot of good evidence to the table. But either way, it's a historic imbalance, and there are two sides to that equation. It boosts China's GDP growth, but others lose out, and that's where I want to turn to Europe. Tell us your forecast for the euro area. I think you're a little bit above 1%, but obviously we see the pressures on Germany, on France, on others that have been driven by many headwinds, but including what we're seeing from China's exports.
That's right. So our forecast is 1.3%, which is not too far from the consensus. And we have shaved that a bit. We were more optimistic a few months ago than we are now, as we saw China double down on this export-driven development strategy in the latest 5-year plan. We took some growth out of Europe. We still think that there should be a boost from the German fiscal expansion. We're starting to see that a little bit more clearly in the numbers, actually. Just looking at the most recent manufacturing orders numbers, there are now more sizable increases in orders for armaments and related goods. So I do think that this is going to come through. We're also getting positive news mostly from Southern Europe, in particular Spain, which is a much more rapidly growing part of the euro area. But the challenges are there, and it's not just the competition from China, which is particularly relevant for Germany, but also some of the fiscal issues, I would say mostly in France. I mean, France's debt levels and deficit numbers are not as high as in the US, but they're still quite high, 5 to 6% of GDP for the general government deficit. France is a much more slowly growing economy than the US. It's sub 1% as opposed to 2 or 2.5% in the US long term. And France already has very high tax rates, and the tax take is more than 50% of GDP. So the fiscal space for adjusting fiscal policy, certainly via tax increases, is much, much more limited in France. So I do think both Germany and France are going to be squeezed in the longer term by some pretty adverse trends, although those trends look different in the two biggest euro area member countries.
And you hinted at this a little, but Southern European strength continues, the divergence?
Spain, yes. I think Spain is still likely to grow in the 2.5% range. And long term, I don't think Spain's potential growth rate is anywhere near as strong. But I think the upgrading of Spain's economy move into higher value added services beyond tourism. That continues apace. And I am optimistic there. I'd say elsewhere in Southern Europe, I mean, Italy being the big economy, I wouldn't expect strong growth, but relative to where Italy has been for most of the last couple of decades, it's a little bit better. 1% growth or so is a reasonable expectation, I think, in Italy over the next couple of years.
And your point about defense spending and investment is just that it can't totally counteract the other headwinds that are coming in, even though that will deliver some kind of boost in 26.
I think it can in the short term. It'll help Germany grow maybe closer to 1.5% in 2026, 2027, but it's more of a one-off boost. And as defense spending goes from 2% of GDP to, say, 4% of GDP, that's a boost while that increase is occurring. But then once you're at 4, you need further increases to get the ongoing boost, and that's probably not going to happen at some point.
And then implications for the ECB, given that outlook?
To me, they're very firmly locked on hold. President Lagarde has talked about being in a good place, and I think she'll continue to say we're in a good place. There have been some talks, some people talking, Isabel Schnabel, the German member of the executive board, have been talking about rate hikes. I don't really see that happening anytime soon. 2% is pretty close to most people's estimates of the neutral rate, and inflation is close enough to 2%, and we think it'll be quite close to 2%. So there's not really any major reason for rate increases, but at the same time, cuts are probably also behind us at this point.
So we get a ECB on hold, but a Fed that cuts.
Please, sorry?
An ECB on hold, but a Fed that cuts next year, potentially.
Yes, from a still significantly higher level. But I think both the Fed and the Bank of England still have some cutting to do, but they are increasingly the outliers amongst the G10 central banks.
Well, that's exactly what I was going to ask you about the Bank of England. That was my next question. Where do you see the inflation picture for the UK? And then what does that mean for BOE? But I think you just hinted at probably a better inflation picture than they've seen this year.
Yeah, I think it's a similar story to the US, where there is underlying improvement in the inflation picture that has been masked over the last year by more temporary forces. In the US, that's been the tariff pass-through. In the UK, it's been the increase in a variety of administrative prices and indirect taxes that show up in the CPI, things like sewerage charges and VAT on private school tuition. A lot of those things have boosted inflation. We think those forces are going to normalize, or we're going to anniversary them in the course of the year. Actually, a lot of it over the next several months. That's going to bring us down to not too far from 2%. And I think that allows the MPC to deliver, we think, 3 additional cuts, 75 basis points, which takes you down to 3% for bank rate by the end of the year. They delivered a cut in December. It was a slightly closer call than we had expected, a 5-4 vote. That probably sets the stage for a pause at the upcoming meeting, I think in early February. But then we think subsequently we'll still get some cuts.
So I have one more question for you, and then I'm going to go to our online questions. So please submit askac.org. We'll get to as many as we can in the 10 minutes we have left with Jan. But I have to ask you about bright spots in EMs. What jumps out to you? I think in India, you might be above the consensus a little bit for next year, but take us through things we should be looking at that we don't always focus as much on.
You're right. In India, we expect annual average 6.7%, and fourth quarter to fourth quarter actually 7%. So solid growth, largely really a long-term structural productivity growth, still pretty strong demographics type of story. This is not really a major cyclical issue, but really growth that can stay structurally strong for many years as India catches up with the frontier. China has already moved down this path quite a bit further. So, China's growth rates, while still much higher than in the US, let alone Europe, are well below where they were 10 or 20 years ago. But India is still at an earlier stage of the process, and convergence is still helping them to a greater degree. Brazil, we think, is more subdued growth. We're at just under 2%. And I think the question, of course, in Brazil is what happens with the sky-high policy interest rates, still at 15%. We would expect cuts there, but not aggressively. So I don't think that we're going to see a major demand or interest rate driven boom in Brazil. So the other thing to note perhaps along those lines is East Asia, and in particular Korea and Taiwan. They've seen a huge boost, Taiwan in particular, from AI equipment. This is the flip side of the point about AI investment not really showing up in US GDP that we discussed earlier. It has very much shown up in Taiwan. I think that's still going to keep growth pretty firm in some of those places.
So here we go. Let me get to the audience questions. I'll get to as many as I can, Jan, in rapid fire fashion. The first one is about your forecast for the dollar, which I imagine, given what you said, would be a little weaker this year, but take us through your thinking and then implications for the rest of the world with a potentially weaker dollar.
It's a little weaker. We're at, in the low 120s for the euro. And, I think from a valuation perspective, the revaluation of the European currencies in a somewhat better cyclical environment than expected in 2025 has probably eroded a significant chunk of the valuation gap. But if we see cuts in the US, interest rate cuts in the US, and we see, a shrinking interest rate differential between the US and Europe, that should help the euro to some degree. I don't have a huge amount of conviction here, but I would expect increases in the value of the euro and maybe other related European currencies to a small degree. The more interesting currency story is probably Asia, because the misalignments in valuation are so much bigger there. I mean, dollar yen at 156 is very, very far away from purchasing power parity. Most estimates are 100. So this is a very undervalued Japanese yen. I think it's a very undervalued RMB. And this is another aspect of the trade imbalance. I mean, one reason why China is managing to gain all these market shares is that the real exchange rate is undervalued. And the same is true for other Asian currencies, Korean won, Taiwan dollar. Cyclically, we don't see a strong impetus for revaluation of the Asian currencies. So we only have, small moves towards stronger yen and stronger currencies more broadly in the region. But if you look out several years, this is really where the big debate is in terms of exchange rate moves. It's not US vis-a-vis Europe. It's really US vis-a-vis Asia.
And the RMB under evaluation conversation has finally picked up steam here in Washington in a way that some have, Brad included, been raising for a long time, but I've seen it grow in consensus. You see the coverage of it. Not that you expect, I imagine, any revaluation significantly
I
this year.
mean, it's been surprising to me that it was not more of an issue during the trade talks.
Yeah.
I mean, I certainly expected the administration to basically push the Asian trading partners more in the direction of reevaluation. But over time, I think we'll still get the reevaluation, but it seems to be on a slower path.
Okay, question here about central bank independence. How do you think about that issue when you're modeling US for the rest of the year? Do you factor in any kind of tail risk from the bond market or otherwise, reading this question, if there is a Fed chair who the markets don't deem to be independent?
I think it's going to continue to be an issue because, of course, the administration is making it very clear what what they want to happen and what the president wants to happen in terms of interest rates, and it's making it a condition for selection to the chairmanship. So I don't think the issue is going to go away. There's also the Supreme Court decision on what happens to Governor Cook, and that's going to be another major market mover. Whether she is going to be allowed to stay in her seat or the president is going to be allowed to remove her. And I think if you were to see a decision that goes against Governor Cook, that would be viewed as a cause for concern around central bank independence. With that said, I don't really expect major effects on the conduct of monetary policy at least in 2026. And the Supreme Court has been supportive of central bank independence in a couple of decisions last year, one around the independent federal agencies in general, where the Fed was singled out as being special. And then in terms of the initial decisions on Governor Cook. So, and you also had the reappointment of the 12 regional Federal Reserve Bank presidents by the Board of Governors in a unanimous decision, including the Trump appointees. That also, I think, is a reason to think that the support for central bank independence is still pretty strong, and the institutional safeguards are still pretty strong. So my expectation is that the FOMC, 12 months from now, is still going to be making decisions in a way that is not so different from the way that the FOMC has been making decisions for the past several decades. But it's important to safeguard central bank independence, and we've seen that globally. And the U.S. is not the only country where central bank independence could be under pressure. In Japan, it's a big decision, or it's a big debate as well. But the cross-country evidence shows that central bank independence ultimately results in lower inflation and better economic outcomes. And so it's something that I'm sure we'll discuss again in subsequent conversations.
I'm sure we will, and I'm glad you raised the Japan issue because central bank independence is not only a US conversation, and we sometimes lose sight of that here being in Washington. I want to ask my final question. We're out of time, but this is what I always ask you, Jan, at the end of these sessions, which is what is the black swan event, the thing we're not thinking about, we should be thinking about? And I went back to the videotape from last year, Jan, and you said higher tariffs than we're predicting. I think that was a pretty good black swan prediction given how the year developed. So what is your black swan event we should look out for this year?
Yeah, I mean, true black swans are obviously things that aren't even on our radar screen. But the thing I am most focused on in the short term is how much of a gap do we get between output and employment? And to what extent could we see a bigger increase in the unemployment rate on the back of increases in efficiency and maybe expected increases in the impact of AI. So far we have seen some constraints on hiring. I mean, we've seen broad constraints on hiring across the economy, some of which can be traced to AI, in my view. But we have not really seen significant AI-related layoffs. And if we were to see more upward pressure on the unemployment rate, I would be concerned about negative feedback loops between employment, confidence, spending, production, back into employment. So increases in the unemployment rate will always get us quite concerned. So we'll be watching that space.
Well, that's something we will continue to check in on with you throughout the year. Jan, I'm very grateful for your time. I know how busy you are, and I appreciate you always starting the year with us here at the Atlantic Council, helping us see both the US and global economy, the risk and the challenges and the opportunities and all the nuances. I hope everyone stays with us throughout the year. We will have a series of events as the US hosts the G20 presidency, on our future of money work, on our economic statecraft work, on our future of capitalism and trade as we await tariff decisions from the Supreme Court and otherwise. So another eventful, tumultuous, and important year in geoeconomics and the global economy. Thank you all for being with us this morning. We wish everyone a pleasant rest of the day.
Thank you so much.